Welcome back, traders and investors. We have Aron Pinson on the line, and Aron is a CFA and co-founder and chief investment officer at LPS Financial LLC. He is joining us on the line today. Aron, how are you doing?
I'm doing good, Joel. How are you?
We're doing good here on our Thursday morning. Uh, can you give us a little bit of your background? What your education, how you got started in the market, maybe some of your mentors in the market.
Sure. I started investing, I would say personally, when I was a teenager. Some bar mitzvah money, inheritance from my grandmother. So back mid '90s, I would say. As far as professionally, we've been, myself and my three partners here at LPS Financial, we've been working together for give or take about 10 years since 2004. So managing money professionally, advising different clients and different investors what to do with their funds, for about 10 years. But as far as just a personal tilt, I've always, drifted with a value investment approach where we look at things like margin of safety. Obviously, different investments have, different upsides and downside risks. So, we want to always look at things that have not only good potential as far as upside, but margin of safety. So things like, Seth Klarman, Warren Buffett, Graham and Dodd. That's really as far as just people that, that I get, just a general concept of where to find and look for investments. Those are those are probably the most important people that have mentored me, not obviously individually, but from reading their books and, learning about their styles, about how to find investments and what to invest in. As far as education and things like that, as you mentioned, I am a CFA charter holder. So that's as far as market perspective and investments. I do have a bachelor's in rabbinical studies, so I am a actually ordained rabbi. But that's obviously back when I was in yeshiva for many years throughout the 80s and 90s, where that's most of the that part of the education came from.
Interesting time that you started, 2004. Now, we've had some people that have come on the show and like, oh, I've been investing since 2008, 2009, and, they have these great performances and, they're great models. And, hey, you've had a great market. There's no reason you shouldn't have that kind of performance. But getting started in '04, you had that period leading up, the financial crisis in 2008. Was that something that you kind of saw on the radar, and were you able to, raise more cash or take more defensive positions? Or did you just take your lumps and just reevaluate and continue to invest?
Right. So obviously every client is different, and one of the key things we focus on here as a firm is really trying to understand what each client is looking for. If you have a specific client who's retired and needs a specific amount of income from their investments, relative performance means nothing. If the market was down 20 or 30% and you were only down 15, that client is not looking for is not getting, what they were looking for from an investment perspective. On the flip side, we have some clients that are looking at relative investments. They want to, outperform the markets. They're looking at specific indices to see what you're tracking. So when we have any client that comes aboard with our firm, we create an investment policy statement with that client, not only to understand the client's risks and to understand what the client, as far as what their goals are, their time horizon, just different metrics about, how much risks we can take. But also, we will, of course, look at, the types of returns we should be targeting. So, obviously we don't have a benchmark as a firm as far as just an index where, this is our performance year over year. Because every client has a different portfolio. No two portfolios are alike between any of our clients' accounts. So to answer your question more directly, specific clients, as you probably can imagine, had pretty tough years in 2008, where their clients' objectives entailed taking on some risks and things like that. And even if we lowered exposure during the downturn. Obviously, that's something where they would have been affected accordingly. On the flip side, more absolute return clients that are more into fixed income and things like that. Obviously, in 2008, you would have had phenomenal returns as the bond market exploded higher during that time frame.
Okay, so you kind of suited to the individual client, and that's one thing that we try and stress too here, as far as an investing goes. If you're looking, if it's your kid's college fund, if something that you're banking on for a new purchase or something, it's saying you shouldn't gamble it, but if it all depends on your time horizon. That's an excellent point. So you're also the author of Microfundy. Could you tell us about that?
Sure. So a little while back, I started a blog, microfundy.com, where again, I look at as far as my own personal responsibilities at the firm. Not only again do I do analysis on specific individual companies and speak with clients and understand clients, create portfolios for them. But we started, more into social media. So after getting on Twitter, and again starting a blog, Microfundy, I tend to share once in a while different ideas that we consider either undervalued, overvalued, a tilt, or something that maybe not, might not be the most understood as far as just an investment. Where I think the insight that I share, could educate investors as well as create returns if traded accordingly. As far as just the type of direction we look at the specific investment. So, for example, I mean, just yesterday I put up a post on TiVo, TIVO, where the investment I think is a very misunderstood. A lot of people think TiVo is still a hardware company like it was back when it started out, selling those actual boxes in the Best Buys and using their DVR recording, which for the most part that business has been in a major decline over the last decade as more and more of these MSOs, these multiple service operators, the Direct TVs of the world, the Cablevisions, the Comcast, these companies have TiVo's own TiVo's own technology in their own boxes. So why do you need another box? And people are not realizing, in my opinion, that the company has been shifting to a more software and cloud model, where their actual software is going into a lot of the smaller tier 2 operators, and they're getting royalty stream of revenue from these providers for every subscriber that's using their cable box. So something like that, where again, we could find specific companies, specific ideas, that there's a misunderstanding overall in general, whether it's from sell side analysts or just your average investor that looks at a company and doesn't understand it correctly. I think that the blog is a perfect outlet to share my thoughts about what the company is doing and what the company really should be looked at, or how it should be looked at. And obviously at that point the metrics are totally different. A hardware company, if you look at a Hewlett Packard or a Dell or even a Samsung, can't be awarded the same type of multiple of cash flows or earnings or any type of metric compared to a software company, let's say like a Microsoft, or you can get into the Apple debate if they're an ecosystem software company or hardware company. So when you have a misunderstanding or a misrepresentation of what a specific company does and what a company is, that's where you really have the benefit as an investor. And it probably takes some patience, but as the market shifts over and really gains the understanding of what that company really does, you obviously have that upside, where at that point there's, of course, realization, and the market awards at a higher multiple, and that's what we think will happen, for example, with TiVo over time.
All right, so just inferring from your site, Microfunding, just your very detailed outlook here on TiVo. You're a fundamental guy, right? You pay attention to the fundamentals, and is that your number one indicator with going into stocks? And how much attention do you pay to technical analysis?
So yeah, it's definitely number one, far and away. Do I focus on technical analysis maybe when entering and exiting?
Okay.
Perhaps. Not myself personally. If I start drawing lines on a chart and explaining that to clients, I would advise my clients to run as far as far away from me as possible. It's not my area of expertise. We do have one of my partners studies charts, and maybe when it comes to timing, where if there's a great idea that comes to the table, and based on charts, we think that there's another leg down or whatever the case is, based on what his expertise is.
Okay.
Sometimes we can hold off and wait a little bit. And same goes with the exit. But myself personally, definitely, that's not my area of focus at all.
Okay, so you like to nail down the fundamentals and then rely on someone else to look at the technicals. So that's good because you have your expertise and you follow it. So going on to that, I mean, let's talk about some of your positions here. You mentioned you like TiVo on the long side here. It's getting harder and harder to find things with good, risk-reward ratios the more the market goes up here. Is there anything else on your long radar?
I mean, one thing that if you look at just from a fundamental perspective, with a similar type of approach, and it is also perhaps not the best entry point. Where if you look at the news yesterday, it did have a nice pop because of some of the earnings that came out, as well as more importantly, a proposed spinoff in their operations as far as some of their subsidiaries. But Barnes and Noble's BKS is something that I've written about on the blog as well. And it's something that if the company can execute in the next couple of quarters and actually deliver in the beginning of next year, as the company announced yesterday, a spin-off of their Nook division, that is something which I do believe could, bring out a lot of value to shareholders. And again, this is a recurring theme that you'll hear from me, or my clients definitely hear from me on a consistent basis, where there is a misconception about a specific company based on their businesses that they operate, misconception about the type of profits they're generating, and even though profits are black and white, but if you have if you only look at a bottom line number and not the things that make that number come to happen. In other words, there's different metrics in between to get to a bottom line net income number. So where do they get it? What metric is moving in which direction? Are expenses moving up or down and things like that? So that's something where even though the bottom line number, is something you can focus on, but it's more important to break it down and to realize how things are operating. So in the case of Barnes and Nobles, if you look at the company's profitability over the last several years, it's practically non-existent. It's non-existent, but for the most part, every single one of these last quarters and couple of years, their retail and college businesses has been doing tremendously well. It was just the Nook business that really has faltered, lost tremendous amounts of money for the company through write-downs of their actual inventory, and even from a perspective of trying to advertise and compete with the Kindle and the iPads and things like that. And as the company has been winding this down and now announced yesterday that they're going to spin it off, that we believe will really show the true value hidden in the retail and the college business, which, just based on an EBITDA number, if you strip out, and even if you say the Nook is worth zero, even as of yesterday's close, you're talking about, the remaining part of the company worth just a few times their EBITDA, and the company could easily lever up, do something like GameStop has done, pay, GameStop GME. They started, buying back stock a couple of years ago, paying a considerable dividend, and the stock has doubled, even though it's in a similar type of long-term, difficult position where eventually, the brick and mortar stores might come to a specific position where they're going to have to, close a lot of their stores and lose a lot of business to the Amazons of the world. But if you look what happened to GameStop as far as their valuation, the stock has, again, doubled in a pretty short time frame over the last couple of years. Barnes & Nobles, if they take that route, use a lot of that cash flow coming from the retail to buy back stock, initiate a dividend, and things like that, there's easy potential even at these levels for a good risk-reward upside, even with yesterday's move.
Is that going to be, is the Nook going to be a separate stock, or they're just spinning off the company and just going to let it, wither away to zero? Is it, what are they planning on doing with that?
Right, so the announcement was pretty vague. They did say it was going to be spun off, so you would assume it's a different stock. Their CEO does have a background where he was the CFO at Cablevision when they spun off a couple of other companies as its own publicly traded company. So you would assume that. It was actually pretty interesting in the conference call. Their CEO didn't answer directly where the college business is going to go into, and that's very interesting because right now Nook Media, that separate entity, was set up when Microsoft and Pearson back in 2012 took an equity stake in that separate entity, Nook Media. But Nook Media it still has the entire college business part of Nook Media. So, if you would just assume, and based on the press release and based on just, understanding what the company is and how it works, you would assume that the Nook and the college business would be separated as a separate entity and just the retail. In the conference call, the CEO was sort of pretty, it was cagey about it, where he was ducking the question to say maybe they would do something differently, where obviously they would need Microsoft and Pearson to sign off of that. Off on any type of changes on that, but if they could just spin off just the Nook itself and keep college, that would be a huge benefit for the remaining company as far as just the retail business. And at that point, the Nook probably would have very little upside. But it is a media company. They sell ebooks. It's not just about the actual tablets. They have some other, ventures as well, of course.
Okay. And just kind of along these lines, and I'm not sure, we had a question earlier here in the chat room about, when they split into separate companies, they convert to a REIT. So you have Iron Mountain. I don't know if you have any charts ahead of you. Iron Mountain announced today that it was converting to a REIT. And the stock exploded from $30 in the pre-market over 37 to 37.31. Now, what's your take on companies like this when they convert to a REIT? Is it, more, are they looking for tax advantages? How does it add 20% to the value of a company that they're just spinning off into a REIT?
Right. So REIT conversions is a very interesting thing. We were investors in a couple of industries that had this tailwind behind them as well. Number one was wireless towers. Where I don't know if you're familiar with American Tower, AMT, or Crown Castle, CCI. So one of them already did. SBAC, SBA Communications probably is going to convert as well here soon. Crown Castle still has some NOLs, so they're going to take their time. And then again with also the outdoor business, Lamar Advertising, LAMR, and then of course the CBS Outdoor just got spun off CBSO. So there was a couple of other industries where, again, these companies are not typical real estate companies. So they're, the IRS initial, rule of having, REIT protection where a pass-through entity can not pay taxes if they pass through all their income, probably wasn't targeted for these types of profitable companies. I guess if you would have asked the initial IRS board or whoever decided to pass this idea, it was probably more for your average individuals or companies that wanted to start and invest in some strip malls or apartment buildings and things like that, actual physical real estate. But the bottom line is that these companies do have actual assets. They have hard assets, real estate, and they do derive most of their profits from this hard asset, and they have tenants. The wireless companies lease out these towers, to the Verizons and AT&Ts of the world, and Lamar and these other companies advertise and lease out that space to all the advertisers, the car companies, and what have you. So they are really, tenant-operated, business where they have real estate, they have those hard assets. So in some cases, in the case of Lamar, it was almost a foregone conclusion that they were going to get that REIT approval, the PLR from the IRS, or the private letter ruling. And, so if you look at the chart of Lamar back when it happened, there was a little spike, a quick sell-off, and the stock's almost at the same level, which, by the way, we think is wrong. We think it's tremendously undervalued based on AFFO, the metric that people look at based on REIT investments. We think there is a lot more upside. But getting to Iron Mountain, there was a lot less certainty. There was so much more controversy if they would be able to get the approval from the IRS, and that's why you see the stock spike so much. We're not, the IRS approval was probably more a 50-50 versus, let's say, a 90-10 for a Lamar. So what, the amount of the upside priced in was obviously a lot less in the case of Iron Mountain. Same goes with a possibility of EBIX, EBIX. EQIX. Equinox, the server company, where they also probably have a less percentage chance or priced-in chance of getting the PLR from the IRS. So, there's obviously, a good reason why the stock has been, spiking pre-market here, and I wouldn't be surprised if it holds throughout the day because, again, having the ability to earn money without paying taxes and, forcing a much higher dividend because these the REITs, as you know, have to pay out, a huge portion of their operating income as dividends. That's obviously something which is huge positive for these companies.
Okay, great answer. We've had Aron Pinson on, CFA, co-founder and chief investment officer at LPS Financial, giving us a fundamental look at the markets. Aron, a lot of knowledge there. Thanks for sharing it with us. We'd like to certainly have you on again.
It was my pleasure. Thanks a lot for having me, Joel. I appreciate it.
Okay, thank you.